No. So one of the things I love you're in these slide decks, although these charts look very fancy and they're very well put together, is you have a really good way of simplifying things. I think your focus on earnings is definitely one that I haven't heard enough people talking about. So when it comes to valuing stocks, right, there are kind of two components to that. There's obviously the valuation that they're getting, and then there's the earnings, right? There's a lot of focus being paid right now. This DCF model that you have, I really like and that probably impacts the valuation, right? So as rates go back up, that changes the amount that investors are discounting those future cash flows, and that's influencing how much investors are willing to pay, right? That's the valuation side of things. But what we haven't really talked a whole lot about, or what I haven't heard about a whole lot, is actually earnings, right? And actually, one of the concerning things to me, actually looking at some of the numbers that you showed, is that the stock market is still projecting, right, 10% earnings growth next year. But for me, I'm kind of looking at what's going on in the world and thinking, I'm not sure with all this withdrawal of liquidity, with deteriorating economic conditions, why the market is still forecasting 10% growth in earnings. Can you talk a little bit more about that side of the equation, the earnings versus maybe the valuation that we've been talking about before?
Yes, so you're absolutely right. Price is at the intersection of valuation and earnings, right? So there are two moving parts in the stock market. One is what are companies going to earn? And over the long run, price follows earnings. Mm-hmm. But two is how much are investors willing to pay for each dollar of earnings, right? And what we often see is when valuations are high, the market is front-loading more years of future earnings growth than when valuations are low, right? So when valuations are at rock bottom, the market's not rewarding any potential earnings growth because it doesn't believe it's going to be there. And at very high valuations, it might be pricing in the next 5 years of earnings growth because investors are so confident that those earnings are going to come through. So the PE, by definition, is the price over the earnings. And if the PE goes down, as it does when liquidity tightens, as it is now, the present value of future earnings goes down, and that's what we're seeing. And we've had a 10, 11-point derating on valuation on a trailing PE basis already. But that's only as good as the E in the PE, right? So the E right now is around $205, $210. That's trailing earnings. The expected earnings for the next 12 months is about 232, 235. Next 18 months is around 245 or so. And those numbers have not budged. Now, under the hood, you can see there are more downgrades than upgrades. The growth rate is certainly slowing. It was 50% last year. It's down to about 14%. Now it's on its way, in the best case scenario, to 10% or so over the next year. But I think, the risk is that, especially when we get to second quarter earnings season, that companies are going to start missing more, and they're going to say, our costs are too high. We're either losing customers, or it's eating into our profit margin. It's going to be one or the other. And even if that doesn't happen, the risk is that if inflation is so hot, and the economy is fully employed, as we know, right? There's an employment rate is only 3.5%. Will the Fed have to keep tightening until it breaks something, until it actually causes a recession, which certainly wouldn't be the first time that Fed tightening has led to that. And in that case, the E would become vulnerable, right? If you're going to have a recession, you're very likely going to have an earnings contraction on top of that. And what makes bear markets really nasty events to have to live through, not just valuation resets, which is all we've had so far, is just a valuation reset. But if you have a true bear market, a recessionary bear market, you combine both the falling PE and a falling E, and then P, the price, has to do double the work to keep up with the falling PE as well as the falling denominator in that PE ratio. And that's why you get bear markets of 30, 40%. And so far we haven't seen that. We're down, in the low 20s as of this morning, down 22 or 23 probably. But that's all just been valuation. And so the risk is that the E is going to be the next domino. And again, I'm looking like a hawk every day for signs of whether that foundation is starting to crack. And other than a few very spectacular misses at the company level, I really am not seeing a lot of signs. The growth is slowing. The breadth of revisions is certainly, slowing. But beyond that, the numbers are actually holding in pretty well. Yeah. So here's the 2022 earnings estimate. This is the aggregated bottom-up estimate that I get from Bloomberg. And it's held in very, very steady. Now, obviously, energy materials are seeing huge revisions upward, but those are relatively tiny sectors in the market. At least they have been, and they still are, but they'll probably get a lot less tiny going into the future.
Yeah. Just maybe, walk me through this. Maybe this is an overly bearish line of thought, but just, tell me where I might be wrong here, right? Lots of focus, and we've talked about it on this podcast as well. Zoltan Pozsar, his whole Bretton Woods 3 framework, where he kind of has made this observation that, when it comes to inflation, there's a supply side, right, which is the amount of, production capacity globally, and then there's a demand side. The Federal Reserve and central banks writ large don't have control over the supply side, right? They can't print wheat. They can't impact the price of energy directly. But what they can do, and what it seems like they are doing, is focusing on the demand side. What they want to do is they want to crush demand. So if that's the explicit goal of the Fed, or that's where the Fed sees themselves being able to have an impact on the inflation right now, what's the scenario? How would that not translate into downward revised earnings, right? Isn't, crushing demand, basically it's explicitly saying the Fed saying, hey, we are going to take down corporate profits or earnings, for the foreseeable future. That's our policy choice.
Yeah, I'm guessing the Fed will probably not use the word crush
right.
as what it's trying to do. I think the Fed would like to tweak the demand and bring it down just enough to take, the heat off of the CPI. But that's a very, very delicate, act of threading the needle, and the Fed, has blunt instruments, and so right. It's, the Fed doesn't often achieve a soft landing. The Greenspan Fed in the aforementioned 1994 cycle did, but inflation never really was a problem in that cycle, either because Greenspan was early enough to tame it, or he just saw ghosts that weren't there. Who knows? But that obviously is not the case this time. So the Fed would like to temper demand and enough, to kind of bring the economy back into balance, because it's certainly beyond capacity at this point. If you look at the jobs numbers, there's 1.9 opening for every job seeker, and so that's the task that the Fed has. And history is not on the side of the Fed trying to achieve a soft landing, and certainly not when inflation is this hot. And you pulled up a chart earlier, the one which showing R-star and the Fed cycle running through it. If maybe we can pull that one up. Yeah. So even with all of the repricing that's happening now, because R-star is likely rising, that those last few data points on that smooth blue line is my own regression model, because the Fed for some reason hasn't released their version of R-star in 2 years since the lockdown. But based on labor force, productivity, credit appetite, or risk appetites, it's very likely that the natural rate of interest, or R-star, is rising. And nominal yields, of course, are rising as the Fed is tightening, but so is inflation. So it's kind of this thing where we're constantly not behind the curve, but we're not getting ahead of the curve in terms of how tight the Fed needs to get comfortably or uncomfortably, as the case may be, above R-star. And you can see in this chart, this goes back about 4 decades, that the typical Fed cycle is like a pendulum swinging from 200 to 300 basis points below the natural rate, or neutral. R-star really is just an estimate of what a neutral policy is, to 200 to 300 basis points above. And we've gone from 600-700 basis points below to still not at, but obviously with what's priced in the bond market, we'll get modestly above it, but we won't get above it to the same magnitude as we have in the past for a number of years, if then. So the Fed, with all of the resetting here of expectations, still may not be doing enough. And the more they do, as you point out, the higher the risk is that they will be too successful in quelling demand, and then all of a sudden you have a recession. And if you have a recession, you have an earnings contraction. And if you have an earnings contraction, that 14.8 times forward earnings will probably still be 14.8 or something around that. But all of a sudden, that earnings number in the denominator goes from 230 to 200, and then you're looking at S&P levels that are a lot lower than where we are today. So that is the great risk. A few weeks ago, that risk was kind of pushed to the back burner because the sense was, inflation's going to moderate. It may not go back to the Fed's target of 2%, but maybe it goes to 4%. And at that point, the Fed at least doesn't have to have the urgency of continuously raising rates, and that the Fed could just go to 3%, and which, as you can see on this chart, 3% would be nominal, of course. This chart shows real rates. But at 3%, it would be basically at or slightly above neutral. And that's kind of a do no harm policy, right? At that point, the Fed wouldn't go so far that it would break something. But with the CPI print last Friday, that narrative is changing, and the market is trying to find its footing, and trying to maybe start to price in that potentiality that the E doesn't hold. But at this point, all the numbers that I've seen suggest that it is, and I'm looking like in the weeds every day.